Have you ever wondered how to start investing? Investing is a journey, an opportunity to grow your wealth, and a way to secure your financial future. It's about making your money work for you, rather than just working for your money. Yet, it's not a magic trick or a get-rich-quick scheme. It requires patience, discipline, and a good understanding of financial markets. The world of investing offers a variety of options, each with its own potential rewards and risks. From stocks and bonds to real estate and mutual funds, the choices can seem overwhelming. But don't worry, we're here to help navigate these waters. Remember, every investment comes with its own set of risks. That's why doing your homework, understanding what you're investing in, and being clear about your financial goals is crucial. This involves more than just following trends or tips. It means doing thorough research and making informed decisions. Investing can be a great way to grow your wealth, but it's crucial to understand how it works before you dive in. So, you're interested in investing, but where do you start? What types of investment instruments are out there? Let's dive in. The world of investing is like a vast sea filled with different types of investment instruments. Each one has its own unique characteristics, benefits, and risks. First, we have stocks. When you purchase a stock, you're buying a piece of a company. You become a shareholder and get a claim on part of the company's assets and earnings. Stocks can provide high returns, but they also come with high risks. Next, we have bonds. Bonds are like IOUs. When you buy a bond, you're lending money to the issuer, which could be a corporation or the government. In return, the issuer promises to pay you back with interest at a future date. Bonds are generally viewed as safer than stocks, but the returns are typically lower. Then, there are mutual funds. A mutual fund pools money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. This allows investors to gain exposure to a wide range of investments without having to buy each one individually. And let's not forget about real estate. Investing in real estate involves purchasing properties for rental income or capital appreciation. It can offer a steady income stream and potential tax benefits, but it also requires significant time and money. Lastly, there are more complex instruments like options and futures, which are contracts that give you the right or obligation to buy or sell an asset at a specific price before a certain date. These are typically used by more experienced investors as they can be quite risky. So, there you have it. A brief overview of some of the investment instruments available to you: stocks, bonds, mutual funds, real estate, and more. Each one offers a unique blend of risk and reward, and it's up to you to decide which one aligns best with your financial goals and risk tolerance. Each investment instrument has its own set of risks and rewards. It's important to choose the one that best fits your financial goals and risk tolerance. Before we delve deeper, it's important to note, this content is for educational purposes only, and should not be taken as financial advice. The information provided is not intended to be a substitute for professional financial advice. It's crucial to consult a financial professional before making any financial decisions. We're here to provide insights and stimulate your curiosity, but your financial decisions should always be backed by professional advice. Now let's move on to a more detailed discussion on a specific type of investment instrument: ETFs. Exchange-traded funds, or ETFs, are a popular choice among investors. But what exactly are they? Let's dive right in. Imagine a shopping basket. But instead of groceries, it's filled with different types of investments like stocks, bonds, or commodities. That's essentially what an ETF is, a basket of investments. But instead of buying each item individually, you buy the whole basket in one go. This is how ETFs allow you to invest in a wide range of assets all at once. They are traded on exchanges similar to individual stocks, hence the name exchange-traded funds. Now, how do ETFs work? They are managed by professional fund managers who decide what goes into the basket based on the ETF's objective. For example, an ETF that aims to track the performance of the S&P 500 index will include the same companies listed in that index. When you buy shares of an ETF, you're essentially buying a piece of that entire basket, gaining exposure to all its underlying assets. What makes ETFs so appealing? For starters, they offer diversification. Because each ETF holds a variety of investments, you're spreading your risk across many different assets. This can help to mitigate potential losses. Secondly, ETFs are flexible. They can be bought and sold throughout the day at market prices, unlike mutual funds which only trade at the end of the day. Lastly, ETFs are often more cost-effective. They typically have lower expense ratios than mutual funds, making them a more affordable option for many investors. Now let's talk about some popular ETFs often chosen for their low expense ratios and suitability for long-term investments. The Vanguard S&P 500 ETF, for instance, aims to track the performance of the S&P 500 index. It contains stocks from top companies like Apple, Microsoft, and Amazon. The iShares Core U.S. Aggregate Bond ETF is another great option. It offers exposure to a broad range of U.S. investment-grade bonds. Another commonly used ETF is the Spider Gold Shares ETF. It aims to track the price of gold and offers investors a way to invest in the gold market without the need to physically hold the precious metal. Remember, while these ETFs are popular, they might not be the right fit for everyone. What works best for you will largely depend on your investment goals, risk tolerance, and time horizon. Lastly, it's worth mentioning that ETFs aren't without their risks. Just like any investment, the value of an ETF can go up and down. That's why it's crucial to understand what you're investing in and to consider your investment decisions carefully. ETFs offer a great way to diversify your portfolio, but remember, it's always important to do your own research. Make sure to understand the ETF's objective, its underlying assets, and the risks involved. And as always, consider seeking advice from a financial professional. Happy investing! Investing can seem complex, but with the right knowledge, it becomes less intimidating. In our journey together today, we've unraveled the mysteries of the investment world. We started at the very beginning, understanding how to initiate our investing journey. It's essential to remember that every journey begins with a single step, and in investing, that step is knowledge. We then explored the various types of investment instruments available. Each instrument, from stocks and bonds to mutual funds and ETFs, has its unique characteristics and potential benefits. It's crucial to understand these nuances before making any investment decisions. Our focus then shifted to ETFs, a popular and versatile investment option. We delved into some of the most commonly utilized ETFs for long-term investment, considering factors like their expense ratio and the principal stocks they contain. Remember, the key to successful investing lies in understanding what you're investing in. However, it's vital to reiterate that this information is for educational purposes only and should not replace professional financial advice. Always consult with a financial professional before making any financial decisions. As we wrap up this session, let's remember that the world of investing is vast and varied. The most effective strategy is to continue learning, researching, and understanding the market dynamics. Thank you for joining us on this journey through investing basics. Don't forget to comment, like, and subscribe to our channel for more insightful content. And be sure to follow us on Twitter at 4YaFreedom for the latest updates and discussions on the world of finance.